So look, I mean, there's certainly been a lot of traffic, and I think that the question everyone's focused on right now is the duration and what's happening to oil markets, and that really seems to be sort of the focus of the conversations right now. And unfortunately, I think this is a situation where we're going to have to wait and see. Right. We have Halima Croft who's weighing in on this for us, and she's warned that there could be, the possibility that things could go on a bit longer than people anticipate. But the reality is that we're in a bit of a discovery process right now. But I think that's really, kind of the topic of the day.
So what does wait and see look like? Are you essentially holding positions where they are, or is there at all any sort of readjustment?
So look, I think this is not the kind of day where you want to be jerking around S&P 500 price targets or that kind of thing. We do a monthly refresh of our target, and this happened to be the week. And so we went ahead and put it out. We weren't making any changes. Our models really haven't been shifting all that much. But basically, it was a good reminder that there are short-term issues in the market that can, potentially take you down in the short term. But longer term, we are still driven by things like earnings growth, economic fundamentals. And that was a good reminder to me that when we're going through an episode like this, we really have to force ourselves to say, if we adjust something, is it going to be just a sentiment-driven move? That's not really the best idea, frankly. But if you have reason to believe and real confidence in the idea that your economic projections are going to change, your inflation expectations are going to change, at some time in the future, then you can make a change. But I would say that when we're in a discovery process and things are moving around and there's a lot of uncertainty about what's even going to happen in the next few weeks, that's not the kind of time you want to be changing a forecast.
So, Lori, should we be cautious about buying the dip? I mean, certainly we're not seeing the dip right now with S&P futures, Dow futures, NASDAQ futures, each down better than 1%. But when it happens, if and when it happens, is the risk reward compelling? And if not, at what level do they become compelling?
So, it's funny. In our same weekly, we actually put out a list of things that we're watching to help us understand when this period of angst might be over. And this was actually, pretty much all written before the issues in Iran surfaced. We knew that there was, sort of increased anticipation of escalation. Odds, were rising that there would be some sort of strike, but we didn't, sort of know all the particulars. But at any rate, what we were talking about were things like sentiment, watch valuations, watch funds flows. What we've noticed on the funds flow side is that institutional passive equity funds have taken a bit of a hit in here. So it's not just retail investors getting fatigued. We were actually seeing a little bit of a retreat by institutions on U.S. equities. We need to watch to see for that to turn because they're an important component of buyers and the market. The other thing we need to watch is sentiment. And I would say this is where probably the most progress has been made. We've been chopping around all year in the S&P on geopolitical concerns, on private credit concerns, on AI jitters or scares, whichever, which way you lean. But at any rate, what we're seeing on the AAII data is that net bulls actually fell back to levels last week that were getting pretty darn close to where they were around Thanksgiving and really close to that one standard deviation level below the long-term average. They're not there on a 4-week average yet. That's normally what we would look to be a trigger to say perhaps this period of angst is over. But we certainly have made, good progress there. And then the other thing we flagged was valuations. If you look at S&P 500 forward PEs, we were basically at peak levels back in August. We've been falling ever since. We're around 25 times now on a market cap weighted forward PE. The average is closer to 19. So there's still some distance to travel to get to that average. But if we are in some sort of nefarious, kind of double digit type decline here, what I would remind you of is that in 2022, that same PE metric hit the long-term average. It didn't stay cheap for very long before markets bounced. So those are the kinds of things that we can watch in addition to trying to figure out what's going on with private credit. What are the answers on AI and what is going to happen with the oil supply in the Middle East? You can watch some of those kind of neutral-ish quantitative metrics to give you some guidance.
Right, Lori. So sticking with this whole conflict that we're dealing with right now in the Middle East, tell me about how you're keeping an eye on both energy and non-energy commodities. Do you see any opportunity there?
So, look, I mean, we just look at the equity market, and I would say that when we look at the different sectors and the different industry groups and where some potential opportunities may lie, a few things jump out. So I would say, first off, let's just look at energy. It's a sector that, no surprise, tends to outperform and go up when oil prices are rising. But there is a debate, right, about how much opportunity is left in that sector, just given the fact that we've been seeing it outperform all year. What we actually see on our valuation model is that it still looks a little bit attractive. And I know that's hard for a lot of people to believe, given the move that it's already have, but that is what we see on the data. I would say something that's even more compelling because we're actually neutral on energy is the healthcare sector, which we're overweight. That one also still has some good valuation appeal. And when we look at its tendency to trade with oil prices, we actually find that both the pharma group and the healthcare equipment and services group tend to outperform. So there's some resilience there and some inherent valuation appeal, and earnings revisions have looked very good as well. So I would say outside of the commodity space, that's one thing that really jumps out to me.